There was first import a couple of important libraries in pandas. In Python, you need pandas, matplotlib, seaborn, these sort of libraries to perform expert data analysis. You could also use NumPy for some of the things. Pandas just for data purpose, in data filtering, data you're making changes in the data, importing data, so all that will be done in pandas. We'll use c1 and matplotlib for visualization. We'll use some of these simple techniques in order to analyze time series data. So we'll first import the data. So I've already downloaded it in and I'm kept it in a folder. So first I'll define my working directory, and then I will import the data using read.csv using pandas. I have imported that. Now what's important to mention here is that when you import time series data, so there is a date column, and that date column is normally a string, but that will be a problem actually if you want to use some of these functions which are specific for time series analysis. You need to assign it as a data type of date, so make sure you do that. So how we can do is that while importing using read underscore CSV, just provide this option, index underscore column is date. So what we'll do is that so you have this date column, right? So it will first use it at the index and use this parse underscore dates as true. That means this particular column will be considered as a date. All right, and then what you do is that we'll see actually what data we have. So we just print. So we have using a print command, we just want to print top rows, top 5, so use head and net. So the data frame is Netflix, so I have used this as name. You can use other names also. All right, so here we see and then the first thing I will do is that I will also need to analyze the return data, but I do not get the return data directly from Yahoo Finance, so I will calculate that. How I do that? So return in a very simplistic form, it is nothing but closing price minus the open price divided by the open price. So that's the daily return I am calculating, right? So in the data you have the open price, the high price, the low price, the closing price, and the adjusted close price, and you have the volume. Okay. Now these are important columns that you need for stock price data. We will be dealing mostly with closing price and the return, right? But in order to calculate return, we need to use open price as well. So, right, so we calculate the return first. It's the difference in the closing price, open price, divided by the open price. So what percentage of change we have seen from the opening price of the day to the closing price. So that's the daily return. Okay, now when you print, you see that you already have the return, right? And here it is in absolute terms, but you can also express that in percentage term. Okay, so the first we will do is that we will plot it. We will use line plot to plot the price data. We'll also plot the return data, and you will see actually how they differ. You might have heard that recently Netflix share has actually dropped quite drastically, over 30% in the last 1 week or so. It's because Netflix is losing a lot of subscribers for the first time, and they exited Russia, and because of this, and all people, it's also we are coming out of pandemic, so not many people are watching Netflix, so the stock is not doing great. And here you see that actually, right, when you plot it in the last few weeks of 2020, you see that there is a huge decline in the stock price, over 30%. The peak was about 650 or so, 650. Now it is somewhere around 200. So that's actually huge. But for the first few months, I would say this peak was somewhere in 2021, and it has been going down for a while, and in the last few days there is a 30% drop. So this is the 30% drop here, and we'll analyze more about it. We have got 5 years of data, right? So we actually see how it has evolved over time. At some point it was less than 200, and it went all the way up to 650. So it has increased over 300 percentage in the last few years. But in the last few months, again, it is not doing that great. The stock price is actually going down, and in the last few days it has gone down by over 30%. Okay, so that's the price data. But in financial world, we are more interested in return than the price data. So we will also try to plot return. We'll do that later. But how can you plot all the stock prices, whether it's open price, close, and volume, everything at once? So use subplots. So it's the same syntax, except that you use subplots is true, and you can mention the size. It's optional, right? And when you do that, you have these plots. Okay, line plot for open price, high, low, closing price, adjusted closing price, and volume, and also return. By the way, we now have return. Even the return is there. But we can also plot return separately, and this is how we've done that. We already have calculated return, so we'll use the plot to have a line plot. And here you see that return is in many ways actually gives you the actual picture about the growth of the stock. So if you would buy share in the beginning of the trading day and you sell it at the closing day, how much money you would make? Some days you will obviously make profits, some days you will make loss, and that's exactly what you see in a return plot. It's a daily return, and you see the positives and you see the negatives also. Now that's interesting. Actually, you see that whenever there is a positive return, it continues, and then when there's a negative return, it also continues. The train continues for a while. This is very typical in a time series stock price data, where you have positive returns for some days, consecutive days, and then you have negative return for again set of consecutive days. All right, so that's how you see it. There are some exception, right? There are some days where the stock return has been more than 8%, and there are also some days where the return has been more than the negative return has been more than 8%. That means the drop has been more than 8%. But what I see here is that they're more positive than negatives, I would say. So if you do a daily trading, then you are likely to make more money actually than you lose money. Again, it depends on the situation, how much money you invest, and how you do that, at what point you actually buy and what point you sell. All that matters a lot. But in a very simplistic way, we can say that for Netflix, actually the daily returns has been mostly positive and less negative, and that's what we see here. We can also plot histogram. So just use hist function here, and we are plotting here the histogram of the closing price. Histogram of stock price actually not very interesting plot. It doesn't tell you much, but when you plot the return, it's an interesting one. Here you see that it's a very normal shape, right? We are now plot. So here you see that we have plotted the histogram of the return, and it's in a normal shape. It's not very normal, it's somewhat orthotic. And in theoretical finance also, we know that stock returns follow log normal instead of normal. That means the tail is with fat, and that's what you also see here, right? There's fat tail, and for most of the days you will be ending up at somewhere about 0% return, right? And you have also some fat tails here. So that's important to know actually in finance, especially if you're a trader. You like to know that. And by the way, so how you actually interpret these graphs actually, if you are an individual investor and you want to invest in companies, so the important thing to know is that if a stock is actually having fat tail, it's a bit volatile. That means it's a bit risky. If you are having high returns, high positive returns, you could also have high negative returns. So it's very volatile, so that's risky. But in cases where there is no fat tail, then it's less volatile and it's less risky in that sense. So you like to know the mean and standard deviation of the return. So that's important. Whether the mean, and we have done that for 5 years actually. It's not always good to actually look at the 5 years of data. You just need to take the last 3 months of data, and then if you want to use that trading strategy, then use just last few months of data, not longer than that. You could backtest that obviously with longer data, your trading strategy, but just to have a view of the company, you need not just have a look at 5 years of data. You could have just maybe a couple of months and maybe maximum 1 year. That should give you a fairly good picture, right? And then we have plotted the cornel density. Cornel density is nothing but is very similar to histogram, just that it's a bit smooth version. So it looks good. If you want to write a paper, you want to document it, provide it to people, I think cornel density it looks better. So you could use also cornel density. It's the same syntax, except that we have used plot, and that kind of plot we want is cornel density KDE. Just mention that and you will get cornel density plot. Okay. All right, so we can also do box plot, although in my view box plot is not very useful. Maybe it's somewhat useful for return data, right? If you do a box plot, most of the times it will be somewhere around. We like to know the mean, and we like to know whether there are outliers, something that we already know from the histogram, by the way. But if you can also use the box plot in order to know that. So we'll use the SNS, which is Seaborn, and you have box plot, and we have used box plot for the return. And you, as expected, the mean is somewhere very close to 0%. That means if you buy and sell the Netflix share for each day and with the same amount, you will end up making nothing, almost nothing, after many years. So yeah, and obviously there are outliers when you will be making a lot of money or you will be losing a lot of money. So the fat tail cases that we discussed just before. Sometimes we need to difference time series. So how we can do that? So when do you need to differencing? Differencing is nothing but, for example, YT. If YT is stock price, then YT minus 1 is first level differencing. Okay, and that's needed in order to get rid of the trend in the data. So if you're familiar with time series forecasting, such as RMA modeling, that's a useful technique that we use. So how you can difference? We have this diff method. So I've used the closing price. You could use other things also. So we are differencing here. Okay, for the first, obviously you will get none, because what it does is that it simply takes the difference between tomorrow minus today. Okay, and for first date, obviously you will not get anything, and then you have values. And after differencing, you will see that the pattern does not change much. It's for the stock, it remains more or less the same. It looks more like return series rather than the price series, right? When you difference. So when you see that the stock actually has increased, because it's first difference, right? That means today's price minus yesterday's price. Okay, and you see that many times it has increased, but in the last few months in 2020, you see there's a huge drops right? You see these bars here, long bars. This was not very evident in my view in the first plot we see, but when you difference, actually it is even more clearer. Okay, sometimes we want to resample the data into for example the daily data to weekly data to monthly data or to yearly data, quarterly data, right? So we need to change this frequency of the data, and that we can also do that. How you can do that? Using resample. Okay, and here I mentioned W, that means I want to make this daily data into weekly data. And how we like to do that? Through mean. That means it will just take the mean of the weekly data, 7 observations, and that will be just 1 observation for that given week. Okay, it could be month also. You just have to change it to M for quarter Q and so on and so forth. Okay, so if you just read the documentation for resample, just do a Google search, you will find what are the abbreviation you can use. So that's very useful actually, because many times you need to change the frequency of the time series data. Okay, in some cases you also could use also sum, but in this case I'm more interested in mean than sum. So this is weekly data. So now when you change the frequency from daily to weekly, then obviously the number of observations is much less. You know, you divide it by 7, that many. Then I put the closing price. Okay, so this is nothing but a moving average for not moving average, but just average of 7 days data, right? When you average out, actually the graph is much smoother, and that's exactly what you see here also. See here, right? It's smoother actually, that right? And if you make it monthly also, it will be even more smoother. All right. All right, so these are some of the things I wanted to talk about. Maybe there are more. Are there more? No.